So I want you to just picture that beige rectangular thermostat on your grandparents' hallway wall. You know the one I'm talking about.
Oh yeah, the classic, with a little physical slider on the bottom.
Exactly, that little slider. And it feels like it literally hasn't changed since, I don't know, the Carter administration.
Right.
And for decades, right, when retail investors like you thought of Emerson Electric, that was the mental image.
Just heavy machinery.
Yeah, heavy machinery, industrial valves, just this slow, predictable, honestly, kind of unglamorous dividend stock.
It is the absolute classic Rust Belt archetype.
Yeah.
Like a company you buy for the yield, you put the stock certificate in a drawer, and you just forget about it for 20 years.
Right. But today, we are completely tearing up that archetype on this special Talk Tickers edition of the Deep Dive.
We really are.
Because, you know, our mission here is to help you find the actual signal in all the Wall Street noise. And we are looking at Emerson's Q3 2026 earnings call. And I got to tell you, that image of the beige thermostat just completely shatters when you actually read this transcript.
It does. It's like a different company.
It is, because right there in the data, the numbers are screaming something entirely different. I mean, semiconductor sales are up 53%.
Which is massive.
And power grid orders are up 37%. So we are not looking at a legacy valve company anymore, are we?
No, definitely not.
We are looking at this like stealthy, hyper-growth AI infrastructure powerhouse. And it's somehow just hiding in plain sight from the broader retail market.
Well, the market still has them categorized in this industrial bucket, right?
Yeah.
They are completely missing the fact that Emerson is providing the foundational architecture for the artificial intelligence supercycle.
Right.
I mean, they aren't trying to build the next large language model.
No, leave that to the tech giants.
Exactly. They are building the physical systems that keep the data centers running those models from, literally melting down.
Which is such a critical bottleneck right now. And before we get too deep into that AI angle, I want to outline the clear roadmap for today's deep dive, just to respect your time and keep this structured. So we're going to divide this conversation into 4 strict pillars. First, the headline numbers, so revenue, EPS, margins.
The core data drop.
Right. Second, we'll look at the story behind those numbers, breaking down the fundamental drivers, the business segments, and some pretty intense geopolitics.
Yeah, the Middle East situation is definitely impacting things.
We will get at that. Third, management guidance, what the C-suite is actually promising for the future. And finally, the 4th pillar, the bottom line.
The actionable part.
Exactly. Is this a bullish or bearish signal for your portfolio? So let's jump right into section 1, the headline numbers. Let's look at what actually happened this quarter, because the top line metrics are just incredibly robust.
They really knocked it out of the park.
They did. So they reported underlying sales growth of 6%.
Very solid.
And their adjusted earnings per share, the EPS, hit $1.71. That is a 13% year-over-year jump.
And that beat the top end of their own guidance, right?
Yes, it did, beating their own estimates. And their adjusted segment EBITDA margin, it expanded by 140 basis points to 28.5%.
See, when a company the sheer size of Emerson expands margins by 140 basis points in a single quarter, you are witnessing like a structural shift in their operating leverage.
It's not just selling a few more thermostats.
No, not at all.
Yeah.
That isn't just moving a few more units. That kind of margin expansion implies they're fundamentally changing what they sell and how they sell it.
So let's actually dig into that underlying sales metric of 6%, because, I always see this term on industrial earnings releases.
Yeah, Wall Street loves that phrase.
They do. They don't just lead with the standard GAAP revenue. They always carve out this underlying number. So can you translate that jargon for us? My read is that it's management's way of filtering out the noise of the global macro environment.
That's exactly what it is. I mean, think about it. If you are operating in 100 different countries, a surging US dollar can make your European revenue look absolutely terrible on paper.
Even if you sold the exact same amount of product.
Right. The currency impact is just a massive distortion field. So underlying sales strips out those foreign exchange fluctuations.
Right.
But more importantly, for a company like Emerson, which, has been highly acquisitive lately, it strips out the immediate impact of buying or selling other companies.
So it's the organic heartbeat of the business.
Precisely. It proves that the core engine, like the stuff they already owned a year ago, is legitimately expanding by 6%.
Rather than just artificially juicing the top line by acquiring a competitor and adding their revenue to the pile.
Exactly. And that organic heartbeat is sustained by their backlog. CFO Mike Bachmann noted their book-to-bill ratio sits at exactly 1.
Okay, book-to-bill of 1.
Right, which supports an $8.2 billion total backlog, and that backlog is actually up 7% year over year.
I was looking at that book-to-bill ratio, and on the surface, a ratio of exactly 1 just sounds like you're treading water.
It can sound that way, yeah.
Like you ship $1 of product, you bill the customer, and you book a new $1 of orders to replace it, so you're flat. But when your backlog is already sitting at $8.2 billion, maybe treading water at the absolute brim of the pool is actually a massive display of operational strength.
It is a phenomenal display of strength, especially when you consider the sheer volume they are shipping every single week.
Right.
Maintaining a ratio of 1 while executing at this high of a revenue run rate, that means their sales teams are hunting down and closing complex, multi-million-dollar contracts at the exact same blistering pace that their factories are turning out the product.
Which is wild to think about.
If that ratio slips to, say, 0.9, you are burning your runway.
You're eating into the backlog.
Right. And if it jumps to 1.2, you might actually have a supply chain problem because you literally can't build fast enough to satisfy the incoming demand.
Right. Customers get mad because of delays.
Exactly. So a solid 1, combined with that 7% year-over-year backlog growth, it tells you, the investor, that their forward-looking revenue visibility is essentially locked in for the near to medium term.
Okay, I hear that, and I agree, but I have to stop you on the cash flow numbers here. I'm going to play devil's advocate.
Go for it.
Because the headline free cash flow looks spectacular. They reported $1.3 billion in free cash flow, up 36% year over year.
A huge number.
Huge. Operating at a 27.1% margin. It sounds like they were just printing money in the basement.
It does.
But when you actually read Mike Bachmann's commentary on the call, he admits that this massive jump was heavily padded.
He did call that out.
Yeah, he specifically mentions an $82 million cash benefit from tariff refunds. And then he also mentions they shifted the timing of their tax payments from Q3 into Q4.
Right.
So I look at that 36% jump, and to me it feels like accounting gymnastics. Are they actually generating that much cash from operations, or did they just get a government handout and delay writing a check to the IRS?
Well, the scrutiny there is entirely justified, right?
Yeah.
Any investor reading a press release needs to look for exactly those kinds of one-time benefits.
Because they skew the reality.
Totally. Shifting tax payments is essentially taking a zero-interest loan from the calendar.
I like that phrasing.
And yes, the $82 million tariff refund was a sudden cash injection that they just accounted for in cost of sales. So it undeniably sweetened the free cash flow optic for this specific quarter.
So the 36% growth is kind of a mirage then.
The cash flow growth number is inflated by those events, yes. But we have to separate cash timing from operational profitability.
Okay, explain that.
If we isolate the actual business performance, we need to look at the EPS. The adjusted earnings per share grew by 19 cents year over year to hit that $1.71 mark we talked about.
Right.
And management was crystal clear on the call. That entire $1.19 increase was driven purely by operational outperformance.
Meaning they didn't get there by aggressively buying back stock to shrink the float and, artificially boost the per share number.
Right, exactly. And they didn't get there through financial engineering. The operations themselves delivered. And when the analysts on the call pressed them on the broader pricing environment.
Because inflation has been just compressing margins across the whole industrial sector for 3 years now.
Right, it's been brutal. But Bachmann confirmed that their price-cost dynamic remains, quote, green.
Price cost is green. That is like the ultimate industrial survival metric, isn't it?
It really is.
It means they have enough pricing power to pass their own rising costs, whether that's raw steel, copper, or labor directly onto their customers, and then some.
Yeah, they actually captured about 300 basis points of growth purely from raising prices this quarter.
Oh, wow.
And they are projecting 2.5% to 3% price realization for the full year.
So they are making it stick.
They are. So while the cash flow had some favorable timing, that 140 basis point expansion in EBITDA margin was very real.
It wasn't an accounting trick.
No, it came from volume leverage, actual structural cost reductions, and maintaining that positive price-cost spread. So they aren't just moving money between ledgers. The core business is operating at a fundamentally higher level of efficiency.
And that efficiency is being aimed at some incredibly surprising end markets right now. Which brings us to section 2, the story behind the numbers, specifically looking at these growth verticals.
This is the most fascinating part of the transcript.
It really is, because it reads more like a Silicon Valley pitch deck than a 130-year-old manufacturing report. I mean, I mentioned the 53% growth in semiconductor sales earlier and the 37% growth in power.
Yeah.
We are in the middle of an absolute gold rush for artificial intelligence.
Without a doubt.
And everyone is obsessed with the large language models, the data algorithms, and the actual GPUs built by companies like NVIDIA. But the physical reality of the cloud is aggressively industrial.
Right. The cloud is not this nebulous, magical concept floating in the sky.
It's really not.
The cloud is a 1 million square foot concrete building filled with racks of servers that require an incomprehensible amount of electricity.
Yes.
And they generate a terrifying amount of thermal energy. Heat is the enemy.
Exactly. And the power grid, at least in its current state, is fundamentally unequipped to handle it. Think about Emerson's Ovation business, where orders surged by 31% this quarter. From my understanding, Ovation isn't like a physical valve.
No, it's not hardware.
It is essentially the central nervous system for a power generation plant. Am I getting that right?
That is the perfect way to visualize it. Ovation is a distributed control system software.
Okay.
If a power plant is a human body, the turbines and the pumps are the muscles, right?
Yep.
But Ovation is the brain. It's the synthetic synapses orchestrating every single movement.
Monitoring everything.
Yeah, monitors the temperature, the pressure, the grid demand, and it optimizes the plant's output in real time.
And right now, the legacy power grid is like an aging brain trying to process a massive, sudden adrenaline spike. I mean, these AI data centers are dropping onto local grids and demanding just gigawatts of power.
It's straining the system to the breaking point.
So when we see a 31% surge in Ovation orders, how much of this is utilities desperately trying to retrofit their old plants to handle this new load?
A massive portion of it. During the call, Ram Krishnan, the chief operating officer, he categorized this current wave of orders as brownfield projects.
Okay, let's translate that. Brownfield meaning upgrading existing infrastructure.
Right. You don't build a new plant, you fix the old one.
So you take a 30-year-old natural gas plant, you rip out the legacy analog controls, or maybe early digital controls, and you install a modern Ovation system so it can actually communicate with a highly volatile modern grid.
Yes. Utilities are looking at the load forecasts for the next 5 years. They're looking at the AI data centers being permitted in their counties, and they're realizing their current fleet control systems are dangerously obsolete.
They're flying blind.
Exactly. They have to squeeze every single ounce of efficiency out of their existing brownfield assets.
But brownfield upgrades can only get you so far, right? I mean, you can't optimize power that doesn't physically exist.
That's the wall they're hearing right now.
Which brings us to the greenfield commentary from management, which I found just absolutely fascinating. They are talking about a totally new wave of demand hitting their project funnel, driven by what they called behind-the-meter data center builds. Let's break that down for the listener.
Yeah, this is a radical shift in how internet infrastructure is being designed globally. Historically, a tech giant builds a data center and just plugs it into the local municipal power grid.
They just pay the electric bill like the rest of us.
Right, just on a much larger scale. Yeah. But the new AI training clusters are so massive and their power requirements are so voracious that local grids simply cannot support them.
They would literally black out the surrounding neighborhoods.
Exactly. So they're building their own power plants.
A tech company is essentially becoming a localized utility.
That's exactly what's happening. They are building dedicated, heavy-duty natural gas, or sometimes even nuclear facilities right next to the server farm, strictly to feed the GPUs.
And that is what behind the meter means.
Right. It bypasses the public grid entirely. It's behind the utility meter. And when a tech giant decides to build a dedicated 500-megawatt power plant to run their AI cluster, they need a world-class control system to run that plant.
Enter Emerson.
Exactly. That is a greenfield opportunity. Krishnan noted that this transition from modernizing old plants to building entirely new ones is giving Emerson a staggering level of order visibility.
I saw that in the transcript.
They are seeing project commitments stretching into the fourth quarter of 2027 and well into 2028.
Visibility into 2028 is the holy grail for an industrial investor. You are talking about a 2-year runway where the revenue is essentially de-risked because the macro demand from AI is so absolute.
It makes their $3 billion project funnel for power look conservative, honestly.
It really does. But let's look at the other side of this AI equation, because they aren't just powering the data centers, they are heavily involved in testing the actual silicon.
Yes, this ties directly into the 53% surge in their semiconductor business, which is largely driven by the recent acquisition of National Instruments, or NI.
I want to highlight a very specific win that CEO Lal Karsanbhai mentioned on the call. He said Emerson is now providing NI semiconductor test systems to a leading semiconductor manufacturer based in Taiwan.
Right. We don't have to guess too hard to figure out who the massive chip foundry in Taiwan is.
No, we don't. But what does it actually mean to provide test systems for AI? Why is testing an AI chip so much harder than, say, testing a chip for a smart refrigerator?
It comes down to architectural complexity and thermal limits. Modern AI chips, like the advanced GPUs coming out of that Taiwanese foundry, they utilize complex 3D packaging.
Okay.
They were stacking chiplets on top of each other. The density of the transistors is just staggering.
Billions of them.
Right. So a microscopic flaw in the manufacturing process doesn't just reduce the chip's performance, it creates a thermal runaway event where the chip literally destroys itself under load.
Oh, wow. So it just melts. So the foundry can't just spot check a few chips from a batch and call it a day.
No, absolutely not. Yeah. They need hyper-accurate, high-speed automated testing on every single unit at a microscopic level before it ever goes into a server rack.
And that is what National Instruments PXI systems do.
Exactly. They provide software-defined, modular instrumentation that can test these incredibly complex chips with extreme precision at high volumes.
Which is why Karsanbhai explicitly stated that this Taiwanese manufacturer chose Emerson's NI platform to accelerate their own product roadmap and capture AI market opportunities.
Emerson is effectively acting as the quality control bottleneck for the global AI hardware supply chain.
That positions them incredibly well. But, the NI acquisition isn't just a bolt-on revenue stream. When you read the tea leaves in this transcript, it seems to be actively rewriting Emerson's corporate DNA. Let's talk about the massive leadership change they announced on this call.
Oh, this was a huge signal.
Peter Zornio, their chief technology officer, is retiring after 20 years.
20 years is an eternity in the tech world.
It is. He built their legacy control systems. But look at his replacement. Huri Sengupta is stepping in, and his title isn't just CTO, he is the Chief Technology and AI Officer. And Sengupta came directly from the National Instruments acquisition.
The inclusion of AI in the C-suite title is a massive signaling mechanism to the broader market. Sengupta led the development of NI's Nigel AI platform. He is a software-defined automation specialist.
So they buy a software-heavy testing company for billions of dollars, and they immediately elevate one of its leaders to the highest technological position in the parent organization.
Yep.
That tells me they aren't just trying to, integrate NI into their existing structure. They want NI's culture to consume Emerson's legacy mindset. They want to move away from being that company that just bends metal to a company that writes the code that controls the metal.
It validates the entire thesis of spending that money to acquire NI. It is a permanent operational pivot. However,
there's always a however.
There is. This exact pivot from hardware to software brings up a massive friction point in their financials this quarter, specifically in their margins.
Yes, this is exactly what I wanted to dig into because it confused me at first glance. I was looking at the Software and Systems Business Group. The underlying sales for that segment grew by a very healthy 11%.
Great top-line growth.
But the actual margins for that segment dropped 30 basis points year over year, down to 31.8%.
Right.
Now, we are constantly told by the market that software is the holy grail of profitability, right?
Yeah.
It has near infinite scalability and practically zero marginal cost of reproduction. So if they're successfully transitioning to software and sales are up 11%, how on earth did the margins shrink?
To understand that margin contraction, we have to look at the painful accounting realities of transitioning a business model. We need to introduce a metric that management heavily focused on during the call, ACV, or annual contract value.
Okay, my understanding of ACV is that it's the metric you use when you are trying to pull off the classic Microsoft or Adobe pivot.
Exactly, the cloud pivot.
Right. You stop selling a perpetual software license, like a physical CD-ROM that a customer buys once for $1,000, and you force them into a subscription model where they pay you, say, $100 every single month, forever.
The software as a service, or SaaS, pivot.
Yeah.
ACV measures the annualized recurring predictable revenue base of those subscription contracts.
Got it.
And Emerson's ACV grew a very strong 9% this quarter to $1.68 billion. So the long-term foundation is definitely solidifying.
Right. Getting a customer hooked on a recurring subscription is great for long-term stability, but how does that explain the margin drop today?
Because of the valley of death that occurs in the accounting during the transition phase. CFO Mike Bachman explained that the 1,000 basis point margin dip was primarily a 1.5 point drag caused by, quote, the software contract renewal dynamic.
break down that dynamic for us. What actually happens on the spreadsheet when a customer renews?
Okay, imagine last year, a legacy customer bought a massive perpetual software license upgrade for their factory. Emerson recognized all that high margin revenue up front in a single quarter.
So the margins look spectacular that quarter.
Exactly. But this year, that same customer transitions to a SaaS contract. Instead of recognizing a massive upfront payment, Emerson only recognizes a fraction of the total contract value in the current quarter.
Because they have to defer the rest over the life of the subscription.
Right. So the revenue recognition gets smoothed out over 12 months, which immediately creates a tough year-over-year comparison against that old, spiky perpetual license model.
So you are trading a one-time margin spike for long-term compounded margin stability.
Yes. It creates temporary turbulence on the books. Add in a slightly less favorable mix of lower margin hardware projects that happen to close in the quarter, and you see a 30 basis point dip.
But the underlying mechanics are performing exactly as they should during this kind of corporate evolution.
Yes, precisely.
So as an investor, I shouldn't look at that 30 basis point drop and panic that their software strategy is failing. It is just the mechanical friction of upgrading the revenue engine while the plane is still in the air.
Both Bachman and Ramkrishnan emphasize this. They are targeting to exit the year with ACV growth of 10% or more. The temporary margin blip is literally just the cost of entry for building a structurally superior, highly predictable revenue base.
Okay, that makes perfect sense. Now, let's zoom out from the specific product lines and look at the macro environment, which brings us to Section 3. Because Emerson is a sprawling global entity, and the geographic data in this transcript paints a very bifurcated picture of the world economy right now.
It really is a tale of two worlds.
The Americas are absolutely carrying the team. The region grew by 8%, and the U.S. specifically boomed with 10% growth. But when you look across the oceans, it's a completely different reality. China was down 3%. Europe was down 1%. What is the read here for an investor trying to balance global risk?
Well, the narrative surrounding China and Europe on the call was cautiously framed as soft but improving.
Okay.
While China was down 3%, that was actually a sequential improvement from their Q2 numbers.
So the bleeding is beginning to clot.
Exactly. And in Europe, while revenue was down 1%, the actual order intake was positive. And orders are a leading indicator of future sales.
So Europe is stabilizing, but it's still essentially flatlining. The broader implication here is just staggering to me. We just discussed how Emerson beat their EPS guidance, hit $1.71 a share, and expanded overall company margins by 140 basis points.
Right.
And they achieved all of this record-breaking performance while two of the largest industrial economies on the planet are effectively in a recession.
It speaks volumes about the strength of the U.S. supercycles, grid modernization, AI infrastructure, and industrial reshoring.
The domestic tailwinds are so powerful, they are entirely masking the international drag.
Yeah.
But let's look at the flip side of that. If they are putting up beat and raise quarters with one arm tied behind their back globally, what happens to the earnings multiplier when China eventually stimulates its industrial sector and Europe recovers?
It's pure upside.
The U.S. market establishes a massive new baseline, and the international markets eventually stack on top of it.
It creates a very compelling long-term setup. However, we have to look closely at the Middle East, because that region isn't just experiencing macroeconomic softness.
No, it's dealing with severe geopolitical friction that is actively damaging supply chains.
Yeah.
So, keeping our analysis strictly focused on the economic and logistical reality of the situation, the transcript detailed a significant operational bottleneck stemming from the conflict and the effective closure of the Strait of Hormuz. Management noted that while their own field service engineers have returned to pre-conflict staffing levels, their customers' operational capacity is capped at roughly 75%.
Which is a huge problem.
Why is a localized conflict capping industrial capacity so severely for these massive companies?
It is a pure logistics failure. The Strait of Hormuz and the Red Sea are critical arteries for global shipping.
Right.
If a chemical plant or an oil refinery in the region is operating at 100% capacity, they're producing massive volumes of product that need to be loaded onto ships and exported.
But if the shipping lanes are closed, or if major fur carriers are refusing to transit due to risk, those ships don't arrive.
So the storage tanks fill up. And once your storage is full, you have no choice but to throttle down your production lines, even if global customer demand is sky high.
Because you physically cannot move the product out of the region.
Exactly. The customers are completely bottlenecked. And if the customers are operating at 75% capacity, They delay their capital expenditure, they delay maintenance, they delay buying new control valves from Emerson.
And this dynamic resulted in a $25 million revenue headwind for Emerson this quarter compared to their original February expectations, right?
Yeah.
$25 million in a single quarter, and they projected a similar headwind for Q4. So we're looking at roughly a $100 million hit to the top line for the full fiscal year, purely due to shipping lane disruptions. That is a tangible, painful hit.
It is. Lal Karsanbhai was very pragmatic about it. He essentially said until broader stability returns, the region is going to be touch and go.
It is a severe short-term headwind. But if we dig deeper into how the industrial sector responds to crises, we uncover a massive long-term catalyst here. When critical supply chains break, sovereign nations and multinational corporations don't just accept the bottleneck.
No, they spend billions of dollars to build permanent infrastructure workarounds.
Necessity forces investment. If you can't put your oil or gas on a ship through the Strait of Hormuz, you have to find another way out. I assume that means building massive overland pipelines to bypass the choke points entirely, moving the product to safer export terminals on different coastlines.
Precisely. And who supplies the complex actuation valves, the pressure sensors, and the ovation control systems to run hundreds of miles of new, highly automated pipeline?
Emerson.
Karsanbhai specifically noted that despite the short-term disruptions, large new projects are moving forward, driven by a surge in demand for energy security and supply chain resiliency.
The ultimate workaround for global energy is liquefied natural gas, or LNG. If you want to bypass volatile regions entirely, you build massive LNG liquefaction terminals in stable areas, like the U.S. Gulf Coast. You freeze the gas, and you ship it anywhere in the world.
And the transcript backs this up. Emerson's LNG project funnel grew by $350 million just in Q3 alone.
Wow.
Bringing the total visible LNG opportunity to a staggering $2.2 billion.
Building an LNG terminal is one of the most capital-intensive, complex engineering feats on the planet. The cryogenic valves and the safety control systems required are incredibly specialized, high-margin products.
So the geopolitical friction in the Middle East is actively generating long-term, high-quality backlog for Emerson's energy segment. They're literally selling the physical solutions to the supply chain crisis.
It's a perfect example of how short-term macro pain translates into long-term industrial capital expenditure, which brings us naturally to Section 4, management's guidance for the rest of the year.
Yeah, let's look at the numbers.
When you synthesize all of this, the AI power demand, the software transition, the geopolitical infrastructure workarounds, the C-suite must be incredibly confident because they fundamentally raise the bar across the board.
The revised guidance for fiscal year 2026 is aggressively optimistic. They raise their underlying sales growth expectations to 3.5%, which translates to a total GAAP sales growth of 5%.
And on the profitability side, they bumped the adjusted EPS guidance to approximately $6.55. They are projecting $3.6 billion in free cash flow for the year.
Which is a massive cash hoard.
It is. Plus, for the retail investor focused on yield, they reaffirmed their commitment to returning $2.2 billion to shareholders.
Right, that's $1.2 billion in dividends and a cool $1 billion in share repurchases.
The capital return profile is exceptionally solid.
The guidance is strong, but the most critical piece of forward-looking information came during the Q&A regarding the fourth quarter.
Okay, what did I miss?
CFO Mike Bachman detailed why the second half underlying sales growth is mathematically designed to accelerate. He specifically pointed to the fact that they are about to, quote, lap the software contract renewal dynamic.
Okay, let's unpack the mechanics of lapping. I hear this term constantly during earnings season. Lapping a headwind, lapping a tough comp. How does this mathematical quirk actually work in Emerson's favor going into Q4?
It goes back to the soft transition we discussed earlier.
Okay.
Imagine a track race. A year ago, during the third and fourth quarters, Emerson took a massive intentional hit to their revenue growth because they were in the most painful phase of ripping out those high-margin perpetual software licenses and replacing them with deferred SaaS contracts.
Right.
The reported revenue dropped significantly, creating a very low baseline on the spreadsheet.
I see. They set a terribly slow lap time last year. So this year, as they run the exact same quarters, they are comparing their current normalized recurring revenue against last year's artificial trough.
Exactly. They have lapped the structural friction. Even if the core business maintains the exact same steady pace it's running right now, the year-over-year percentage growth will mathematically spike in Q4 simply because the denominator, last year's number, is so unusually small.
It provides a massive optical tailwind to their earnings profile as they close out the year. They aren't just relying on the macro environment to drive growth. The underlying math of their own accounting cycle is heavily skewed in their favor for the next 3 months.
Which brings us to the ultimate synthesis of this deep dive, Section 5. We have unpacked the headline beats. We've explored the mechanics of the AI cooling and grid modernization supercycle. We've broken down the ACV software transition and the geopolitical infrastructure workarounds.
They've covered a lot of ground.
We have. And I want to look at this strictly through the lens of a retail investor evaluating their portfolio. Based on the data in this Q3 transcript, is this a bullish or bearish signal for Emerson Electric? Taking a comprehensive look at the operational leverage and the forward guidance, I view this as a strongly bullish signal. There's a multi-layered thesis here that provides both aggressive upside and deep structural protection.
Let's build that thesis. Give me the primary pillars of the bull case.
The first pillar is the valuation asymmetry of their AI exposure. Retail investors are desperately looking for ways to play the artificial intelligence supercycle without paying the stratospheric, heavily inflated premiums demanded by pure-play Silicon Valley tech stocks.
Without paying NVIDIA multiples, basically.
Exactly. Emerson is a backdoor entry into that exact same supercycle.
Right. They are selling the thermal management, the advanced semiconductor testing, and the critical power controls that the tech giants fundamentally cannot operate without. The 53% jump in semi-sales and the 31% jump in Ovation power orders prove they aren't just talking about AI, they are actively capturing massive market share in the physical infrastructure build-out.
Exactly. You get high-growth tech exposure, but it's anchored to the valuation and stability of a 130-year-old dividend-paying industrial base.
That's compelling. What's the second pillar?
The second pillar is the structural elevation of their profitability. We discussed the transition to software and the growth in annual contract value. Software inherently commands vastly higher gross margins than bending metal and shipping heavy valves.
As that ACV base grows, targeting 10% plus growth by year-end, like they said, it permanently raises the baseline margin floor of the entire corporation. We saw 140 basis points of expansion this quarter in the face of international macro headwinds.
Right. They are evolving from a cyclical manufacturer into a higher quality, highly predictable, software-defined enterprise.
Which leads perfectly into the third pillar, downside protection. Investors often overlook the composition of Emerson's revenue, specifically their MRO business.
Yes.
MRO stands for maintenance, repair, and operations. This is essentially the spare parts and servicing division. But what makes it so critical to the bull case?
It is critical because of its sheer size and its absolute necessity. MRO currently makes up 65% of Emerson's total sales. Almost 2/3 of their revenue doesn't come from convincing a customer to build a brand new facility. It comes from maintaining the facilities that already exist.
Let's take that a step further. The underlying mechanism there is regulatory and operational survival. If an oil refinery or a nuclear power plant is running 24/7, the physical components wear down, a specialized pressure valve degrades.
Right.
If that valve fails, the plant doesn't just lose a little efficiency, they have to shut down the entire operation at a cost of millions of dollars a day. Or worse, they face catastrophic safety failures and massive regulatory fines.
Precisely. They have strict turnaround schedules and mandatory maintenance cycles. So even if a brutal global recession hits tomorrow and capital expenditure freezes entirely, meaning no one is building a new data center or a new LNG terminal, that existing refinery still has to buy replacement parts and software calibrations from Emerson. They have no choice.
It is non-discretionary spending. MRO acts as an incredible shock absorber for the stock. When 65% of your business is effectively mandatory life support for critical global infrastructure, you have a massive recession-resistant revenue floor.
You combine the explosive upside of the AI greenfield builds with the structural margin expansion of the software transition, and you backstop all of it with a 65% recurring MRO floor. It's a formidable financial profile.
So, the actionable takeaway for you, the listener, is clear. If you already hold Emerson in your portfolio, the combined 2.5% to 3% price realization, the massive dividend, and the billion-dollar buyback yield make this a definitive hold. You let this multi-year supercycle play out.
Agreed.
And if you're evaluating an entry point, you are looking at a company sitting on a $12.4 billion total project funnel that is perfectly positioned at the absolute choke point of the next decade's most vital infrastructure needs: power generation, AI physical architecture, and global energy supply chain workarounds.
The underlying data strongly supports initiating or maintaining a position.
Now, before we sign off, there was one moment during the analyst Q&A that completely stopped me in my tracks. We've spent this entire deep dive talking about economic drivers efficiency, AI demand, supply chain logistics. But an analyst brought up a catalyst that isn't driven by economics at all.
Oh, this was wild.
It is driven by an existential threat. I'm talking about the cybersecurity discussion.
There's a very stark pivot in the tone of the call.
The analyst explicitly referenced recent, highly publicized, state-sponsored cyber hacks across the U.S. water sector, specifically pointing to vulnerabilities that were exploited in municipal facilities in Michigan.
Right.
Now, Lolkar Sanpai was quick to clarify that no Emerson or Ovation control systems were compromised in those attacks. But the fact that the question was asked at all illuminates a terrifying macro reality for the industrial sector.
It exposes the sheer fragility of legacy infrastructure.
Exactly. Think about how many municipal water grids, regional power plants, and chemical refineries are currently running on 20-year-old early digital control systems that were never designed to withstand a modern state-sponsored cyber assault.
It's a huge liability.
This raises a massive, provocative question for you to consider as you evaluate the next decade of industrial stocks. Are we on the verge of the largest forced upgrade supercycle in history, driven entirely by national security?
If the Department of Homeland Security or the EPA looks at these hacks and realizes that legacy control systems are active, existential liabilities, the entire capital expenditure paradigm shifts.
A utility company won't upgrade their central nervous system because interest rates dropped by 50 basis points, or because they have a little extra budget at the end of the quarter.
No, they'll upgrade because they have to.
They will upgrade because they are legally, politically, and existentially mandated to do so. The spending becomes compulsory. And when a regional power grid is forced to rip out its vulnerable legacy tech and install secure, encrypted, software-defined networks, who do they call?
They call the companies building the foundational architecture.
This cybersecurity mandate has the potential to supercharge Emerson's brownfield modernization funnel in ways that no financial model has even begun to price in. It is a chilling catalyst, but from an investment standpoint, an incredibly powerful one.
It's definitely something to watch closely.
We want to thank you for joining this special Talk Tickers edition of our deep dive. Your time is valuable, and your portfolio deserves the depth of analysis we strive to bring. Keep looking past the headline metrics, keep digging into the mechanical realities of the global supply chain, and remember that sometimes the most cutting-edge AI infrastructure plays look exactly like a beige thermostat from the outside. Stay curious, stay informed, and we will see you on the next deep dive.